All right. So up next, we're going to talk about the double declining balance method. All right. So the declining balance method is based on a multiple of straight line. And there are a few different versions of this. There's the 1.5 declining balance method, or even the triple declining balance method. They all function the same, but the only one that we're going to be responsible for is the double declining balance method. So we have the same asset here. All right. And we need to compute the straight line rate, right? Which I talked about is always 1 divided by the useful life. All right. So in this case, 20%. And as the name indicates, we're going to double that. So 2 times 20% gives you 40%. And then depreciation expense is 40% of the beginning of period book value. So in the first year of operations of this asset, you're just going to take 40% of 10,000 for a depreciation charge of $4,000. All right. So the depreciation table here is a bit different as well. All right. So we have beginning of period book value and then end of period book value. So the asset was acquired at the end of 2016. So in 2017, you take 40% of the depreciable basis, giving you depreciation expense of $4,000, accumulated depreciation of $4,000, and a book value of $6,000. This $6,000 rolls. So the end of period book value for 2017 is the beginning of period book value for 2018. All right, take 40% of that. Add to the 4,000 to get accumulated depreciation of 6,400 and a book value, in other words 10,000 less 6,400 of 3,600, and of course that rolls, and you repeat the process. All right. The only thing to be aware of, however, is that keep in mind we didn't subtract out the salvage value. So each year we want to make sure that we're not depreciating below the salvage value. It's kind of a manual check. All right. So in other words, if we were to take 40% of $1,296, you get more than the $296 here, but you can't take that as a depreciation charge because it would result in a book value below 1,000. So when you get towards an asset, towards the end of an asset's useful life, you want to make sure that you don't depreciate below the salvage value. In this case, the 296 we see has an alternate computation. It's just the cost less the salvage. No, actually, it is the 1,296 less the salvage, which gives you the 296 as depreciation expense for that year. Right? And of course, we'll work through this in class. All right. So as you can see, the straight line method is by far and away the most commonly used depreciation method. And it makes sense because it's simple, straightforward, and it gives you predictable depreciation charges. Units of production really is most useful in manufacturing. And it makes sense in manufacturing because generally the more you make, the more you're going to sell. And so the more you sell, the more revenue you would have. And when you have more revenue, it makes sense to have more to have more expense, because you can cover that expense. So if you have to take expense, you want to take it when you have the revenue to offset it and still be profitable. Accelerated, other methods. So these are really what we haven't covered. And then your declining balance is 4%. Right. So that's your relative proportions of depreciation methods used by companies. Okay, so a few slides back I mentioned that depreciation is reported as an offset or subtraction from the related asset categories on the balance sheet. So here we see cutout of the balance sheet. So race vehicles and other, furniture, software, DJ graphics and equipment, shop and track equipment, giving you property and equipment, gross, which means really that's the total cost of it, but then we have less accumulated depreciation, right? So the net balance sheet effect of plant, property, and equipment is the difference between the gross, which really is what it costs, and the accumulated depreciation. For this instance, that'd be $172,703.